right, guys, welcome back to earnings season. This is the Showdown episode where we are trying to uncover, we're going to have a boom or a bust for Bitcoin and stocks over the next couple of weeks. Guys, we were out last week, but we are back. And Trav, I'm going to start just kicking it over to you, man. I know you've been working deeply on earnings season, looking at the current banking situation and I guess just all the data that's coming out. I know we've got even more stuff popping next week, but why don't we start by just doing a quick overview of what's happening and how the stock market has reacted, because over the past few weeks there's been a lot of fear around the banking crisis here in the US, and as usual there's been a ton of gloom and doom, but the stock market seems to be holding up, as does Bitcoin. And we'll jump into the charts, but where are we overall?
Yeah, we're 10 days into Q1 earnings reporting season, and there's been some pretty good news overall, particularly in the financial sector. That was one we were watching with bated breath, hoping that banks didn't report really terrible Q1 earnings and bad deposit outflows leading to further crisis in financials. And so it looks like things have stabilized there. There are some banks that are still seeing deposit outflows, but overall they're pretty manageable. And the share price performances after the regional bank reports have been pretty good. Most banks are actually up after earnings, at least 2 out of 3 or so. And there haven't been any really crazy gap downs on any bank stocks during this week of earnings for regional banks. And big banks like JP Morgan, of course, are doing great still. So overall, I'd say we've avoided what a lot of people feared this first 10 days with financials. Now, if you look outside of financials, when you look at things like big tech, we've only had a couple of those report, but Tesla, Netflix, TSM, a little bit weak. The share price performances have been mostly negative after those reports. And so going into next week, we have Amazon, Google, Microsoft, Meta, and more S&P 500 companies reporting than any other week of earnings season. So we'll know a lot more next week, but I would say it's been a mixed bag overall, but certainly good news on the financial side, maybe not as good on the tech side so far.
All right. So are we out of the banking crisis, or is there more to come? I guess that's the $300 trillion question in the short term.
Yeah, it's a great question. We're all still trying to figure it out. We're looking at weekly Fed reports. We're looking at bank balance sheets. We're definitely the stock geek name. We're living true to the stock geek name over here. Just geeking out over as many details as we can to try to read the signals. But I would say right now, it looks like things are pretty calm. Like even the Fed's data, the weekly data is still showing that banks are actually gaining deposits again in the first couple of days of April. And that is obviously great news. So we're not seeing more run on the banks. But we also saw in 2008 that we had a period of calm after Bear Stearns failed. And we did see the markets rally through late spring, early summer. And then, of course, we had the Lehman failure and the collapse in the GFC really kicking off in the fall of that year. So we may not be out of the woods, but right now it is looking pretty good overall.
Yeah, the indices have been trying to hold up on multi-month support. The first month of the year, we had a big push in the S&P and the NASDAQ. And then we had a pullback to really important support, which actually held. And then as of right now, that NQ level is still trying to hold at 13,000. And Bitcoin's had a pullback over the last couple of days, but it's still up. Let's see, on the year, it's still up about 69%. So that's nice. But yeah, we've actually got major resistance here around 30,000 on the yearly chart. You can see it was actually the close of 2020, the open, and basically the low of 2021, and then kind of the mid-range point for 2022. And so I've been looking at different strategies and doing some back testing, trying to figure out, okay, what are the probabilities that we break above 30? But at the end of the day, I think that, Bitcoin is, until this changes, Bitcoin's going to follow what stocks do. And so if stocks can hold up and then we get a squeeze, like if we could get a squeeze up above 4,200 on the S&P, I think that would really send Bitcoin above 30K as well. But all these markets are still at these major important price levels that it's kind of hard to anticipate. I think for me, the way that I'm trading this is just looking to respond, right? Whenever we get confirmation, then hammer longs instead of trying to guess if it's going to work and then get chopped out. Nikki, how are you trading this action?
Yeah, I think this is a pay for confirmation market, especially to the upside. I mean, I'm surprised that the Nasdaq is actually looking a little bit stronger than the S&P, in my opinion. And when you look at the price action here, but I think that a lot of people are just going to be like, the volatility has disappeared in both the Nasdaq and the S&P, and you can even see that in the volatility index, the VIX, how that has declined. So I think that it's just that battle between bulls and bears right now of kind of watching paint dry and the wait and see mode, because big tech, as you guys know, they make up a huge portion of the S&P 500 index, right? So I think that that is really what's going to dictate tech earnings, is what's going to dictate how investors look at, what is guidance going to look like. Is it going to be better than anticipated? Is it going to be worse than anticipated? And then they'll react. Like, the market is going to be very reactive over the next few quarters, in my opinion. And this price action just kind of shows that, how we're just kind of hanging out, consolidating, no real volatility. Futures traders must be really frustrated over the past few weeks. But yeah, that's kind of my take from here.
So basically, next week is going to be kind of a do or die, you think, at this level?
Yeah, I do. I think that we're just going to be in a very reactionary environment in the price action, and we're really, really testing those resistance levels. So we have to just kind of wait it out and pay for that confirmation before really making any major decisions, in my opinion.
Yeah, that makes sense. As far as crypto goes, it's actually been a relatively quiet past week or so. Um, we've had a little bit of a pop in altcoins, but we've also seen some fake out breakouts. And one thing that I've just been really focused on is like the Bitcoin dominance chart. And we're testing kind of this 49% zone, which, for anybody that doesn't know, if you're new, Bitcoin dominance is what percentage of the market cap is made up by Bitcoin of the total crypto market cap. And so I think we're going to continue to see this go through 50% unless something really big happens. I'm more bullish on Bitcoin in the short and medium term than I am a lot of small cap alts. So yeah, we'll just have to keep our eye on that and see where alts lead. But over the past couple of weeks, we've seen ETH get a little bit of a pop, but then you can see it gets sold right back into this area. So still kind of a playing the crypto markets conservatively. And I've actually been spending a lot of time just back testing different strategies that I've been trading manually over the past decade, and have been showing our community, just different ways and results of things like dollar cost averaging. And then another strategy that I use that's called the buyer of last resort, which is how I've been able to buy a lot of crypto markets at the pivot lows. And if you think of this strategy, it's like, when is the best time to buy? It's when everybody gives up and things look like they're dead. A lot of times that's where you get the best risk to reward. And so that's really what I've been focused on, is honing in, now that we have a decade of actual price history, being able to go in and fully backtest these things and show not only the results of the trades that I've taken, but like very rules-based approaches to trading the crypto markets. And before, over the past couple of years, we didn't have enough data to really fully backtest systems, but I think we're starting to get to that point where it makes sense to do that. So I've been handing out these strategies to everybody in the community, and have been doing some back testing in Discord, and it's just been really good to see that. So that's where we are on the crypto front.
Yeah, we've got two big events coming up that are probably going to affect all global markets here in the next couple months, really in the next 1 to 2 months. We've got the Fed meeting on May 3rd, and then we've got this big debt ceiling fight here in the US that's gearing up probably for a peak sometime in the early June timeframe. So that's gonna create some fun headlines, some fun potential trading volatility. We'll see how it shakes out. I think if those actually play out relatively positively, we could see markets rip higher through the summer. And if we essentially climb that wall of worry, that would remove two big headwinds. Now, those could also provide us the headwinds to essentially triple top or, in the indices and head back to lower lows. So, so those are going to be key things to watch on our side for, the next 1 to 2 months, besides earnings, of course.
Yeah. Let's also talk about the macro picture. I know last week we had CPI and that's GDP. I'll pull up CPI, but talk a little bit about, what's happening with inflation, what's happening with not just our GDP, but also China's, and just, I guess, the macro picture. It seems like last month and really, Q1, everybody was obsessing over the macro picture and trying to figure out how that's going to drive prices. But I don't know, has anything new come to light, or where are you guys on that?
No, I think macro wise, we had the CPI and PPI inflation data come in a little bit lower than expected for the March data. And that's good news. We continue to see inflation cool. Nonetheless, I think a lot of people still think we're going to be in this Fed higher for longer scenario. I actually am going to fade that a little bit. I think it's going to be really confusing though, because the April inflation CPI numbers could show like a flattening out, and could show a lot of people are going to probably be concerned that core CPI in particular is remaining pretty elevated. And so that is going to provide a little bit of a head fake and a little bit of ammo for those who think higher rates for longer is the scenario we're going to be in. But if you look forward a few months into summer, the largest component of the CPI, that shelter component, and we talked about this before, but people seem to still be sleeping on it. The shelter component is a lagged component, and it will start putting downward pressure on the CPI by sometime in the middle of the summer. And so I think by the time we exit the summer period, the official inflation data is going to be well below where the Fed funds rate is today, meaning the Fed is going to look offsides again. They're going to look offsides on the other side by the time we get into the fall timeframe. And so they're going to have enough cover to potentially cut rates by, I would say, the fall to winter timeframe of this year. Now, will they actually cut at that point? They're going to be stubborn to not cut, but the market is not going to like the Fed being at rates well above where inflation is printing by late summer.
Yeah, it looks like the probabilities are pricing in back into the threes early next year. So yeah, just kind of keeping an eye on inflation. We're down from 9% to 5%. Do you guys think that trend is going to continue or hang out here?
Obviously, one of the big X factors that could influence it higher would be energy. If we see another big spike up in energy prices, energy is one of those commodities that can flow into so many other areas of pricing, whether that's the pricing of food, whether it's the pricing of transportation, et cetera. So energy can have a big effect. But again, if you look at the largest components of CPI, you can't really escape the fact that 30% of the CPI is going to put downward pressure on the number. So it's going to be, I think, interesting to hear from those who think higher for longer is the right play when we start seeing CPI come in at, I don't know, 3.5%, 3% maybe by late summer. So yeah, I mean, again, energy could provide one of those tailwinds for inflation and could change the picture. But right now we're still seeing energy prices relatively subdued. We've had energy stocks and energy prices this week performing relatively weakly. So yeah, right now, at least from what we can see, it's not looking like the downward trend in inflation is going to abate when we look on a multi-month time frame.
I think one of the concerns with energy was the China reopening, right? And it
Mm-hmm.
looks like the China GDP, Chris, you had that up before, but it looks like it came in kind of better than expected, and it's accelerating essentially. And so that's annually. They have the quarter over quarter, which was still a little bit above expectations, I believe, at 2.2% quarter over quarter. So I am thinking about that and how to kind of approach how a China reopening could affect energy. But so far, China has been, seeing strength in GDP and recovery, and oil prices have kind of, they've increased a bit, but we're still not seeing crazy, oil prices yet. But yeah, prices are definitely holding up on oil.
Yeah, they've been down this week, and year to date, I think they're just slightly negative now. We had seen a gap up after the OPEC surprise cut, but since that cut, they've actually started to weaken a little bit again. And so right now, like year to date, I think crude's down like 3%. So it's
Yeah.
really
Yeah.
not
That
been
was
it's not been a concern. Now, again, that could change
yeah.
in a matter of a month or two in energy markets, but right now it's not something I think we have to be super fearful about. The economy picture from the bank side, like Bank of America, JP Morgan reported credit and debit card spending up between 6 and 10%. And so that suggests the US economy is still kind of chugging along. We saw weekly claims rise a little bit, but still, relatively in line with where they've been the past couple of weeks. So there's not any data that's telling me to be super bearish, even though, like I said earlier, we do have a couple of things that could potentially provide a bearish narrative in the debt ceiling fight and the Fed. But, beyond that, if we can climb that wall of worry, it would not shock me to see stock prices higher by mid to late summer.
The other thing is in some of the big bank reports, they noted that the charge-off rate was still below pre-pandemic levels, even though it's been increasing. So
Yeah.
for consumer debts, right? Like credit
Yeah.
cards. So that's another thing to kind of add to that list, Trav, that you're kind of talking about.
Yeah. So I'm trying to remain relatively neutral as far as, just taking in data and trying to figure out where things are headed. Like, it's a very mixed picture. But I certainly wouldn't put myself in the super bearish camp, even though I'm positioned relatively conservatively in the portfolio. I also think, again, we could get thrown off the tracks. We could get thrown off the tracks by something that happens in energy markets, by the debt ceiling, by something popping up again in the banking system. But as it stands today, as I stand and look at things this week, like, even though, it's not like super bullish territory out there in terms of fundamentals, it's not super bearish either. So I
Are
can
you
definitely
coming
see the
over to
pain
my
trade
side?
higher.
Are
Yeah,
you coming over to my? I've been talking about this like forever.
yeah. It's
I
funny
feel
because,
like a broken record.
yeah, I mean, you've been totally right. You said we'd probably just be in like a relatively choppy environment while the market figures out what the hell's happening with the economy, and that's been mostly true.
It's the resilience is that that's what I'm kind of thinking through is like as disinflation happens and discretionary income kind of improves after wage gains, it's like, okay, as long as nothing goes crazy with banking and we have a credit tightening situation, but we're not in a credit crunch, we're not in a credit crisis, right? And I just keep going back to that Goldilocks where it's not great, but it's resilient as hell. And so that's kind of where I've been. And you're right. Like the data is not pointing me either towards this super bearish
Yeah.
viewpoint. Maybe the lows are in, right? I mean, who knows? But
It
I'm not saying we can't see a pullback. We absolutely can see a
yeah.
pullback and an earnings recession. But just like how bad is it going to be is the big question mark.
So basically next week is really where to look out for.
I think tech is going to be very important. Yeah.
Mm-hmm.
Yeah, and it's interesting to note, like TSM, the largest semiconductor wafer manufacturer, the most important one in the world, they reported this past Thursday, and they indicated that server shipments and PC and smartphone related shipments were down year over year. That may have a negative read through for Apple. Interestingly, too, Apple reports a little bit later than it normally does. Usually, they report the same week as the other big FANG stocks, but they're actually, I think they're not reporting next week, but the following week. So I don't know. Could Apple miss? Apple stock's been pretty strong, but TSM is suggesting that smartphone could be weak, server could be weak. That could affect the cloud businesses, the big tech. It's going to be interesting. Right now, Tesla, Netflix have showed us like maybe big tech is not in a great spot this earnings season. So it'll be interesting to watch.
So are you buying a dip if we see a pullback and a big correction in the S&P 500 and other stocks? Like that's the big question, right? Like because we probably will see a correction. It's just a matter of is it a buyable correction?
Yeah, great point. I don't know. It's so hard to figure out from the macro picture right now what to do. So I've just been kind of in my T-bills and chill strategy where I'm soaking up those 4 to 5% T-bill yields on my excess cash, just kind of waiting for something to play out one direction or the other.
It's not a bad place to be, man. Just waiting for a high conviction play.
Yeah.
I'm long Bitcoin. I bought the dip at 19K and that's basically it. Just waiting, sometimes the waiting isn't where you can make your most money or at least preserve your capital and not do anything stupid that gets you in trouble.
Absolutely.
All right, cool. So moving on, we got a few things to chat about: millennials and home ownership rates. This is kind of interesting, showing that millennials are way lagging Gen X, boomers, and the silent generation as far as home ownership rates going back to the 80s. What do you guys make of this?
Well, the context, I think, from the person who tweeted this, Jenna, was that it's actually not that bad. Like, it's kind of impressive that the millennials are where they are with home ownership in comparison to the other generations. And I think millennials have had a slow start, a much slower start. Just kind of looking at that Gen X line, that's a bit steeper of a you know of a curve there than the millennials. But millennials have also had a lot of help from their baby boomer parents to be able to own homes. I actually know a lot of people personally that have had to use help from parents to own homes. But I think that the overall idea here is that it's not as bad as we would expect. And I think that maybe going forward, this could improve from here, and we could catch up quite well. But
Hmm.
I don't know. What's your take? That was my take, but we're still behind, of course. But in the next 10 years, I think that, we could see a nice catch up there.
Yeah, I don't know. It's hard to think about this because all I think about is like anecdotes, right? Like if you look on Reddit, which is just overrun with, like the anti-work crowd and people complaining about finances, you would, if you only spent your time on there, you would think that millennials everywhere can't afford housing. And I know, they have gotten squeezed with prices being so high in recent years. And then, to add super high interest rates over the last 6 months, it's like, yeah, I don't know. I mean, whenever I looked at this chart, I thought it was actually kind of
Thought it
negative,
was
but
bad.
yeah, but I mean, it makes sense. I mean, the line continues to go up, and as millennials inherit some wealth from boomers, it's gonna probably help that even more. But
I think that right there is the key that a lot of people aren't thinking about is millennials are going to inherit a mass amount of wealth from baby boomers, and tax free, by the way, which is nice, or very low tax. But basically, millennials may just catch up in that way, like by inheriting their parents' homes and brokerage accounts and etc. So even though millennials have had a rough go, um, 2008 financial crisis when they started working, now the pandemic, now another slowdown and possible recession, and just everything in between, and housing prices being a huge headwind. I think that the inheriting side is going to get interesting to see where millennials actually end up shaking out in the end once that kind of happens.
interesting.
Could they be in like way better shape than any other generation, essentially? If you think about it, because generations before them, their parents maybe weren't so invested in stocks and didn't have such a bullish stock market. But boomers have had the most bullish stock market because they were investing throughout 0% interest rates, right? So massive growth in the stock market that maybe prior generations didn't have for their children. So it's an interesting dichotomy when you think about boomer wealth and what that's going to do for millennials going forward. Not everyone's this lucky to be able to inherit money, but some people are. Many people are.
Well said. Trav, I want to ask you about ARK's latest profit target for Tesla. I know you are a massive Elon fanboy, and ARK's expected value for Tesla in 2027 is $2,000 per share, which after the recent splits, what is it right now? Let's see.
So that would be a 6 trillion plus market cap. I think that would be something like a $6.3 trillion market
At
cap.
$165 now. I guess, yeah.
That
It's a
2K
little bit of
price
a gain.
target must be with reverse splits or something, right?
I don't know.
No, she likes to put out these. So she had put one out a few years back for, I believe, 2023 or 2024. And it looks like Tesla's going to miss that pretty wildly. I think, or maybe it was for 2022 that's already passed. I forget exactly, but she had put out another absurd price target that she was pretty far off. And, I think 6 trillion within 5 years is certainly and a very aggressive price target. Tesla right now is kind of going the opposite direction. Like they had cash flow come in way lower than expected for Q1. They've been cutting prices on a lot of their models. Gross margins have been in decline. So it's really not looking super bullish for Tesla at this moment. Now there were some bright spots, like their energy business is starting to grow again. They've got potential for launches in the Cybertruck. They keep talking about, they're starting to spool up production for that. We'll see. And then, of course, at some point, they're going to have to refresh the Model S, maybe the Model 3, maybe other models coming out. So there are avenues of growth for Tesla. Like the market still expects Tesla to grow over the next 5-6 years, but they're gonna have to maintain this premium valuation multiple that they still have to the existing auto industry and go well above and beyond that, even to try to match this ARK price target. I don't think it's a reasonable price target. If you look at their financial models, they're riddled with errors. They're riddled with just absurd, even in their bear case assumptions, just absurd assumptions. So I would take that with a heavy grain of salt.
I saw on Twitter the other day, somebody put out clips of Elon going back to, I think, 2014, where he's like, yeah, full autonomous driving is going to be here in 1 year. And then every year it was like he was saying the same shit over and over and over. And then there was most recently, I think a week or so ago, that he was also like, yep, by next year, fully autonomous. Is it ever going to happen? Trav, I know you did a lot of deep work on this. Like, I kind of gave up. As you guys know, I very publicly canceled my Cybertruck reservation when Elon said he wasn't going to take Bitcoin and he starts pumping Doge. And look, I'm critical of Elon. I know he's doing a lot for the world. I get that. But like, when he starts doing this ridiculous shit, you've got to kind of point it out, right? And so I did that. But I've kind of lost faith. Like, I don't think we're ever going to have this fully autonomous driving, or am I missing something?
It's kind of like the boy who cried wolf. At a certain point, like you can't believe the guy after 7 straight years of saying it was coming probably next year, and it doesn't happen. They're still trying to work out bugs in the software. You can go see people that have the beta. They go and post some of their drives on YouTube, and you can see all the errors that still happen. And so it's not there. I do think it will happen at some point. I do think the state of AI is advancing so quickly. The hardware is advancing so quickly. Now, it's one of the hardest problems I think we have in the realm of AI, just because of all the edge cases, the speed at which things happen when you're driving, the trade-off of like, the whole problem of like, how does the car choose between bad situations if it's got to, make a decision about crashing into a barrier versus crashing into a pedestrian, right? I mean, there are strange things, edge cases that may never be fully worked out because even human drivers are provided with these scenarios, and we don't always make the right decision. So I think, I mean, the autopilot thing has been a big part of the bull case for Tesla. And I don't think that they've been honest about it. And I think that like when you look at, ARK and their price targets, they bake in that autopilot becomes this massive robotaxi business for Tesla, and they're the only ones and the only winner in the entire auto industry. I just find that far-fetched, especially given what we've seen. So yeah, it'll come. Will it be Tesla? Hard to say. Will they be the only company? Probably not. We've already seen other companies like Cruise and Waymo also coming up in their improvements in their own services. So
who's leading the pack right now? Who's actually got the best tech?
Depends on who you ask. There's a wide range of opinions on that, based on number of miles driven, the disengagements and things like that. And really, you could fight all day about who the leader is. Tesla obviously has the most actual cars on the road because they're willing to beta test with real people's lives.
That's kind of scary, man.
Yeah.
Yeah. I know someone who got very, very, very critically injured and almost died by trusting his autopilot. Yeah. And the autopilot, of course, on the highway just drove him right off the highway, and he was in the hospital, broken many, many, many bones. So I don't know. You hear these stories more and more, and it gets a little freaky.
Yeah. Definitely. Yeah. High stakes, high stakes in so many ways. And, I hope that they'll keep improving it because, the alternative is that we've got a very dangerous system on our roads, and if it's not improving, then we have a problem.
Put your hands on the wheel, people.
All right.
It's close enough.
Guys, I wanted to ask you, is 60-40 dead? Because that was the narrative last year, right? It was like 60-40 had one of its worst performing years ever. And our buddy Colin Roach says that 60-40 looks better than it has in a long time, mainly because we know the math on bonds look better than it has in a long time. So, the chatter last year was that bonds are stupid, 60-40 is dead. Let's go elsewhere. We're going to search for yield. What do you guys think going into the future? Does it still make sense to have I think 40% is a pretty massive allocation to bonds, or should people maybe look at something else?
It's funny how things change in a year, right? We did go from bonds are dead, bonds are trash to, bonds don't look too bad, whether that's T bills, T notes, T bonds, whatever you're looking at. But yeah, the fact of the matter is now that interest rates have kind of come to, we're thinking end of the cycle of the hiking cycle, right? Well, what goes up must come down, and the whole idea here is that as well, we're going to see basically bonds increase in price as interest rates decline again, because there's that inverse relationship between price and interest rates. So I do think that it is starting to look interesting. It's been looking interesting to put bonds in the portfolio, especially T bills, as people have been utilizing, and Travis as well has been utilizing that. But the 60-40 is like a classic. It's almost a balanced portfolio. It's a little bit more aggressive than a balanced portfolio, slightly. And balanced meaning a 50-50 stock bond, right? So it is on the more conservative side. But it's been a well-performing portfolio that balances risk and reward pretty well over the years. So I think that it's not dead at all. I think if you have a more conservative risk profile, then it's something that doesn't look too bad going into the Fed potentially having to lower interest rates within the next year or whenever that is going to happen. You said, Chris, 40% is a bit high. It depends on the person, right? It depends on who you are, what your risk tolerance is, and where you are in your life cycle, your accumulation of wealth, life cycle. So, but yeah, it's not dead at all.
What about like a third stocks, a third crypto, and a third bonds?
A third crypto is high. It's a high
Is it
allocation
though?
for a lot of people. Maybe not for you and your followers, and like people in our community are probably definitely they can stomach the higher crypto allocations, but a third is kind of a lot.
Yeah, I mean, look, my range is anywhere from like 15 to 50%, depending on where we are in the market cycle. But
50%.
yeah, I know. I mean, look, I get nervous when my net worth gets over 50% in crypto.
You do.
Yeah, I mean, I'm like, hey, I need to pare this back, because I know if it falls 80%, that's going to drag my net worth down quite a bit. So I like to smooth it out. I love crypto, but I'm not a crypto maxi as far as my net worth goes. Like, I want to own equity in companies, and I mean, I guess bonds, well, kind of boring, but
I mean, we don't even have a large bond allocation, but we do have some bonds, and the great thing about investing is you can do whatever you feel comfortable doing, right?
Trav, do you have any bonds?
Yeah. But I hadn't owned bonds for pretty much all of my investing career until just recently. I bought some government bonds, and they're still, it's not like they're going to be like home runs at best. Like you get, a 4.5% yield, but that's pretty good. I mean, the S&P's dividend yield is much lower than that. And then, to find quote unquote safe yield is still kind of difficult. Like corporate bond spreads are pretty thin. So yeah, so I like the treasuries right now as a really just a cash alternative. Like I don't plan to be in them for a super long time, but right now I think they're actually potentially a decent value, given the fact that I think rates are going to head back well below 4 at some point here in the coming quarters. So like I'm fine with it. My T-bills and chill strategy. But hey, keep in mind, this debt ceiling thing is kind of scary. It could knock some volatility could knock treasuries off a little bit here and create some volatility, at least short term. I don't think the probability of a technical default on U.S. treasuries is non-zero. and maybe higher than it's ever been, although it's still very, very low. And most people expect the debt ceiling to get extended at the last hour or, on the last day or two or week before
And
shit.
that's how they usually do it, right?
Yeah.
It's like this big event. Everybody knows what's going to happen.
They're
And
so
then,
annoying.
yeah.
But here's the thing. We know that like partisan politics, it's become hyper partisan in the past few years.
Yeah.
Mhm.
And could they use this as, their platform for creating a crisis and blaming it on the other party? It's quite possible. That's the scary thing. Like, again, I think it's low probability, and I think it would only last for a few hours. But in that few hours or maybe, 1 day period, if that happened, like things would go haywire. CDS contracts would trigger. You'd have counterparty risk like blow up throughout the system. You might have forced sellers of traditional, riskless assets. And we know that the treasury yields essentially are an input to valuation on every other financial instrument out there for the most part. So like, yeah, it could create a real problem for like 24, 48 hours.
Potential buying opportunity.
Yeah.
Yeah, it's worth thinking about and being prepared for. Yeah, I think it maybe would be a buying opportunity, but it would feel very, very scary. It would feel like absolutely terrifying at that moment.
Like the flash crash type situation.
Yeah.
It would feel kind of like that.
They might even have to
Listen,
shut the markets.
I am numb to scary events. I wrote a strategy literally called the buyer of last resort. And we were here in the panic of COVID buying the lows, even the latest banking crisis at 19K, I almost low ticked this entry. It's like, I love scary events, man. Like if you can get yourself to get comfortable with that, those are oftentimes the most profitable times to buy. Granted, you can buy in the middle of a meltdown and it just keeps going down and down and down further than you're comfortable with. But I don't know. I love considering myself being that like buyer of last resort,
Definitely.
Yeah, I mean, we love a good sell-off in the markets. I mean, 2020, Trav and I were in there. We were in our prime. We had our fighting gloves on. We were like, let's buy some stocks. So
we didn't have anything else to do.
Yeah. What else are you going to do? Play video games or buy stonks? Let's go.
I don't even so, we would have still, even if it happened today with tons to do, we'd still be in there, if the market sell-off happened like that again. But yeah, it's nothing to be afraid of. You just have to be prepared. And I would, even though I've been I wouldn't call myself bullish. I'd call myself kind of just sitting neutrally, but probably tilting slightly more bullish. Even though I am that, I would love to see the market correct and give better valuations. I would love that. And I'm ready and I have cash and I'm waiting. So we'll see. But yeah, interesting.
We should definitely keep an eye too on crypto as we approach the debt ceiling, like the max. Like it'll be really interesting to watch the price action in Bitcoin in particular as the crisis, so to speak, ramps up with the debt ceiling fight. And maybe they resolve it like well ahead of time, faster than people expect. That's also a possibility. But if they don't, and they take this thing to the midnight hour again, or even beyond, I'm going to be really interested to see how crypto performs in those few days around that. It could be a standout performer in a flight to capital potentially, or maybe it just acts like a risk asset like everything else and sells off massively.
Yeah.
It's gonna
my guess is we'd get what we got back on the 19K pullback. It would be an initial washout with fear. And people would be like, oh, wait, why am I selling Bitcoin with a banking crisis? And then we'll buy back in and it'll pop. I don't know. That's my anticipatory move. We'll have to let price action be a guide, but yeah.
I think I'm giving Congress too much credit. I'm like, they know what this will do to the markets and bond portfolios that are already struggling. They wouldn't do this to us.
Come on, they wear suits. They're very intelligent people.
I'm being way too optimistic.
Yeah.
Way too trusting.
Nick, there was a tweet you put out I wanted to talk about. You said there's 3 must-dos to build more wealth. I thought this was solid. What do you want to cover on this?
Okay, so the 3 must-dos are 1, tracking your cash flow, 2, understanding your tax situation, and 3, assigning cash flow to the right investing accounts. And you might be thinking, well, duh, Nikki, tracking cash flow is so obvious, duh. But you would be shocked at how many people don't do it. They are literally doing number 3 before they do 1 and 2. And that is what most people do, but it's not going to be the most efficient way to do things. So that's why I wanted to put this tweet out, because a lot of people listening might even be doing that. They might be just putting money in accounts, oh, I should put money in this account, my 401k, my taxable, whatever, but they're just putting the money in without thinking about A, what percentage of my cash flow should I actually be putting in here? And B, what is my tax situation to maximize and be the most tax efficient as possible? So, that is something that I think is really important. And I just want to remind everybody, because I came across somebody that wasn't tracking their cash flow and they were doing 3 before 1 and 2, as most people do. And they were investing in the wrong accounts and, for their tax situation. And I see it all the time. So sometimes the most simple things need to be reset.
Yeah, I mean, to us it's simple, right? But we're in this full time, and a lot of people are just so focused on, hey, I have a job or I have a business that I need to operate, and they go from I need to make money and then put it in the markets. And I guess what you're saying here is like you can just be strategic about it. You don't have to do anything super complex, but just like talk to a CFP or a CPA that knows their shit and figure out what is the best way. Because if you're investing and you're not minimizing taxes, that's actually a drag on your returns, right? Because taxes are the biggest expense for a lot of people. And if you optimize that and you minimize taxes, that is going to give you a huge boost in long-term wealth growth.
Yeah, and the thing is it's not even that complicated. You don't even have to necessarily talk to a CFP or a CPA. You can figure out this is what I teach in my mentoring program. I'm teaching people how to figure out what is their effective tax rate. Okay, what tax brackets make more sense for Roth versus traditional, kind of giving guidelines, right? And that's it. That's like all you need to know. Just know your effective tax rate, know how different accounts act in terms of taxation, and then you can very easily make determinations on your own which account is best for you. For some people, it's a no-brainer. It's like if you're a higher income earner, you're going to want to get the tax deduction versus the opposite of that. So it's not even as complicated as it sounds. It just takes learning your effective tax rate and learning the account taxation.
Here. All right. You guys want to do some Q&A?
Let's do it.
All right. Got a question. What do you guys think of trading gold futures? I started following a system. Is it too risky to trade gold futures, or is this market prime for gold to grow to new highs and the volatility helps for trading? Trav, what do you think? Do you trade commodities?
Very little. I've done it a few times in the past, but there's usually a lot smarter people in those futures markets trading those commodities that know the ins and outs of every little supply demand change. They, know the positioning of all the other futures traders in aggregate, so that it's tougher than it seems. Like a lot of people will wade into futures markets. I mean, remember just 3 years ago, I think it was like 3 years ago, this past Tuesday or Wednesday, that crude oil futures went negative, which a lot of people didn't realize could even happen. And so it blew up some retail traders who were buying oil at like $3 a barrel, thinking they were getting a bargain. And then it went to negative, 30 or 40 a barrel in one day, and they were margin called and completely wiped out. So yeah, futures markets, you have to understand what you're doing. Futures contracts have some complexity. The underlying commodities themselves are going to have financial speculators as well as industrial buyers and sellers in that market. So you have to really know those markets. Or, I mean, this person says they have a system. If you do have a really well back-tested system that is working, super well, then you might have something, and then you keep trading it until the alpha runs out, so to speak. So if you've got something like that, do it. I don't have that at the current time, at least not in stuff like gold or crude. But it is interesting to note, I mean, performance of gold's been really strong. It started to come back in as the banking sector panic has waned a little bit. But, gold hit that 2K an ounce level, that psychological 2K level. Didn't hear a lot of people talking about it. And gold was performing pretty well year to date. It has come in, like I said, in the last week or two. But if we get back into that panic mode situation with either the debt ceiling or the banking crisis stuff, gold could have more room to run higher, I think, this year if those things play out.
Yeah, I think gold's one of the most bullish charts in the markets right now, actually. I mean, it's got a massive cup and handle we've been talking about for many, many months, if not years. And yeah, when I've actually outsourced all of my futures trading to funds that actually hire PhDs and mathematicians and stuff. But whenever I was day trading the E-mini futures, Oil and gold were like some of the hardest markets to trade. They would get really thin. I would see them run stops. It was a lot easier to trade the stock indices, in my opinion. And gold is a much slower moving market. I've just found a lot more inefficiencies that I can exploit in the crypto markets where, yeah, I mean, gold's one of those markets that's like overrun with professionals and algos. And you've just got to, yeah, like you said, Trav, just really back test your system and make sure you have an edge. Because if not, they're going to take you lunch money.
Gold and oil always kind of felt like choppy markets. Like even when I was trading futures, they kind of always felt intraday choppy and tougher. So I agree with that.
Yep. Yeah, the algos really like to run stops in the commodity futures markets. All right, next question. They say we should not trade Bitcoin for profit. Wonder who they is. It is for hodling, not like an altcoin. What do you guys think about the opinion? Well,
I know the answer to that.
Well, go for it.
No, you're going to say no. It's not just for hodling. It's you have a book on trading Bitcoin for profit. So.
Yeah, I mean, when this person says, and there's not a name attached to it, but when they say you should not trade for profit. Yeah, if you're talking to Bitcoin maxis who are like they pump out the whole like traders are traitors, trading, everybody loses their money as a trader. Look, if you're a market participant, if you're a hodler, a long-term investor, a short-term trader, or anything in between, you are a trader. You are participating in the markets. You are trading. And if you don't develop the skill stack of trading, of understanding portfolio management, on down to TA, on down to strategies and, how to backtest and edge, everything in between. If you don't have that skill, you're just a gambler. And I've seen over the years, a lot of people that consider themselves Bitcoin maxis and hodlers, they're like, oh, trading is stupid. But then they're the ones that sell the low because they don't think about themselves as a trader. And therefore they behave like a gambler and they lose. And so even if you do want to just be a long-term investor, learn the skill stack of trading. It will help you. It'll help you develop an edge. It'll help you hold through pullbacks and drawdowns. And everybody thinks like, oh, people that were early to crypto got so lucky and now they're all rich. Yeah. Do you know how hard it is to hold through a 70 to a 90% drawdown in an asset class?
Very hard.
Hindsight's 2020. Yeah. So that's why I think trading makes sense. And that's why I've actually been sending out these strategies to our community showing like, hey, look, guys, here's the actual results if you did certain types of DCAing, right? So like we talked about the buyer of last resort, but like what happens if you dollar cost average and you buy, say, $500 a month every month where Bitcoin is 50% below its all-time high? Well, $500 a month over 68 months, your net profit is almost $2 million on something like that, right? But where can you get even more juice is if you start to trade, let's say you traded a $10,000 account and you invested 10K and you recycled those profits into being a buyer of last resort when everybody thinks that Bitcoin's dead. Well, that's 6.8 to 6.9 million in profits starting from a 10K account. So, there's so many different ways to trade Bitcoin, but you would be a fool not to look at the fastest growing asset class with the most volatility and say, oh, I'm just going to buy and hold. Why? You could get so much more alpha if you're an active trader.
Well, I don't think there's anything wrong with people that want to buy and hold. It's just a matter of choosing which strategy is going to be best for the person, right?
Sure, absolutely. And not everybody should trade. And a lot of people do lose money. But like, I just get annoyed with these maxis that are like, oh, you shouldn't trade. You should just buy and hodl. Yeah, the problem is 95% of people are going to buy at the highs in bull markets and panic sell the lows. I've been doing this for a decade. It hasn't changed every market cycle. Everybody thinks they're smarter than the crowd. And people that don't put the work in, they're not, and they end up losing. That's why I do what I do. Try to help people.
And I think there's an important point that we should reiterate there, which is, to to talk about a buy and hold strategy on anything volatile, people like to talk about buy and hold on Amazon, back in the .com bust and what that would have meant. You shouldn't have sold your tech stocks. You should have just held on to, your Amazon. You'd be up 20,000% or whatever. Well, most people probably couldn't have stomached the 90% plus drawdown in Amazon in 2000 to 2003. And so like that's what I think what you're saying is like buy and hold. Sure. Like if you can do that and you're willing to do that and you find the right assets to do that on that, great. Or even potentially like maybe there's some DCA strategies for stuff that's like really great long-term assets, but it's not always evident when you have something that's volatile that could go down 60, 70, 80, 90%, that like you'll be able to hold that you'll be able to quote unquote hodl. And so I think that's what makes it challenging. It's like in theory, when you look at all the stuff that would have made sense to buy and hold, in theory, it makes sense. But when you meet the actual practical application of that in real markets, it's like, how many people are willing to do that on something that's volatile? And so, yeah, if you can, awesome. But you also have to pick the right assets because, there's people that are hodling SPAC stocks that are down 95% and probably won't ever come back because they're terrible businesses, So it's like, there's an asset identification piece to this. There's also like the behavioral finance piece, and to get good at both is difficult. It's a skill set. Yeah.
Here. Well, we can go ahead and start to wrap it up there. I guess next week, the big thing is obviously all the tech earnings, as well as the 30K zone on Bitcoin, and the debt ceiling. What other landmines or potential black swans do we have coming up that people should be aware of?
Ooh, good question.
China tensions, Taiwan.
Yeah. Well, that's always a possibility.
The Russia-Ukraine thing is still going. I don't know. There's a lot of variables in play right now, from the macro to regulatory stuff on crypto to international conflicts. Like this has definitely been an interesting past couple of years,
to say the
least.
least.
It has. Yeah.
We love it though. I mean, this is where you make money, right? Is through big panics like COVID and banking crises, and if you can just be dialed in and get a hold of your emotions and develop the right skill set, you can build life-changing wealth while everybody else is freaking out and running for the hills.
Yeah, these are the moments that really build you as a trader and investor. And it's like people that lived through the 2008 financial crisis, they knew how to approach, the events of the past few years a little bit better. And now we're going to have this under our belts too. And it piles on to just make us better and better at what we do. So it's great.
Yep. Well said. So, guys, if you are not part of the community, I'm going to go ahead and pull this up. Go to wetalkmoney.com/community. You can check out what we're doing. You can get into our Discord channel and our live classes. And also, all of our members are going to get access to the strategies that I put out there. Some of them I talked about today. I've got more coming down the pipe. But basically, we want to give you the tools, the knowledge, and the resources you need to build life-changing wealth. And with that said, Trav and Nikki, thanks for joining me. Any last words of wisdom before we wrap it up? On the spot.
I don't
something brilliant that will live in infamy.
I was just thinking about something else. I was thinking about pickleball. So I don't know. I would say stay patient. This is a tricky market environment we're in still. There's good, there's bad. Stay patient and pay attention to the data. Take it as it comes. That's all I got.
that was okay, but Trav, I want you to really rock our socks with some.
He'll do way better than me.
No, let's see what he's got.
Build your bunker. The Fed meeting, the debt ceiling, the wars, it's all coming. No, just
Get your
kidding.
canned goods.
Your canned goods and your bunker ready. No, yeah. Look, I'm in full geek out mode. Come join us. Look, you don't have to do your investing by yourself. Come join us either in the community or, find us on Twitter, find us on our accounts. Like, let's talk. Let's try to, make money together. That's the best way to do it. So yeah, come find us wherever you are, engage with us. Let us know what you're looking at. Let us know how we can be helpful, and let's all make money together. Let's get extra rich.
Cheers to that. Here's my little Waterloo
kombucha.
Cheers.
Yeah.
Do a whiskey and wisdom here soon.
There we go.
All right, guys. Thanks for watching. Don't forget to subscribe. Leave us a review on any podcast platform. Make sure you're subscribed to the new YouTube channel, and we'll see you next week.
See ya.
Cheers.